Hello Sector Watchers, welcome to the show. This is the 194th episode of Sector Spotlight for Monday the 23rd of October. My name is Julius de Kampenaar and I am presenting to you from Amsterdam in the Netherlands. Today I want to take a look at obviously asset class and sector rotation, and following a couple of comments on my last video, have a quick look at what's happening in sector rotation on small caps, as well as the comparison between equal weight and cap weighted sectors. Ladies and gentlemen, this is Sector Spotlight. Let's start with a look at asset classes. On the left hand side the weekly RRG, on the right hand side the daily RRG. And without going over all of these tails, there are a few relationships that stand out. Let's take a look at the big elephant in the room. That's the comparison between stocks and bonds. So here on the weekly, we've got SPY still inside the weakening quadrant, but at a negative heading. And we see government bonds, corporate bonds inside improving, strong heading, and high yield has already reached the leading quadrant. If we look at that same comparison on the daily chart, then we see how SPY moved into the leading quadrant over the last 5 trading days, but now started to roll over, quickly started to roll over. It's only the beginning, but it's not very encouraging that when you just entered the leading quadrant, you're already starting to roll over. And on the other end, we see corporate bonds, gov and high yield inside the lagging quadrant, but immediately starting to move back up. So contrary to the move in the stock market, which is the usual pattern. But how do we relate this to what's going on inside the longer rotations? And here I think it's all taking place very close to the benchmark. So there's not a lot of strength behind this move yet, I should say. It's starting to pick up, but nevertheless, it doesn't look super positive. It doesn't look super strong. And it's kind of what we're seeing in the market over the last couple of weeks, that SPY is having trouble to maintain its support levels. And we look at the chart in a minute, you will see that it is still hovering above that 420 area, which is kind of dangerous. And the government bond ETFs have already broken down, pushing the yields higher. So all in all, this macro picture isn't all that great. Now, what is the scenario that could play out here? If we see the daily tails of SPY continuing that negative rotation and moving lower, and the vice versa for the fixed income tails, then that could support the moves here on the weekly. So I think it's important now to look at the relationship between stocks and bonds directly. So that's the SPY IEF chart. I'll look at that in a second. As well as the price chart of SPY. I think if that breaks important support levels and we're having that rough 420 area, that could be a trigger for an acceleration lower, which would make our look at sector rotation even more important to see what are the safe havens, what are the areas to hide in case that happens. Now the one that really stands out, or the two tails that really stand out on this RRG here, are the commodity ETFs. So that's DJP and GSG. You see that they're inside the leading quadrant on the weekly chart, and you see that they are, and I've got GSG right here, nice moving tail, heading strongly towards that northeastern direction, towards the leading quadrant. And we've got DJP a little bit ahead of that, already inside that leading quadrant at a strong heading. So we're going to take a look at those charts, but I think that commodities definitely deserve a position in a portfolio, in a balanced portfolio right now, especially when stock markets are getting a little bit weaker. Commodities could be a very good place to add some allocations in the portfolio, as they are doing relatively very well compared to VBINX, which is the benchmark that we're using for this exercise. And then the final tail, the final asset that I want to talk about is Bitcoin. You see on the weekly chart, you see the tail inside lagging, but curling back up. That's usually a good sign. But if we look at the daily tail, then you can see how Bitcoin has gone through a very long rotation through leading. And, you know, because Bitcoin is going through such massive moves, this seems the beginning here, but you can see on the daily how long that move is already underway. And the pause that we had seems to have come to an end, and Bitcoin's tail has now rapidly curled back up and is heading towards the leading quadrant. And if we look at the Bitcoin chart in a minute, you know why that is. So let's start with a look at the chart of SPY. That's what everybody's looking at. And here is the daily version of that chart. We talked about that potential head and shoulders pattern, about the neckline and the pullback, and it looks as if that was indeed a pullback. And we're now back to challenging that support area around 420. Again, today, this was Monday, the market is just closed, just barely managed to hold up above that level. So for this week, that 420 area, I'm going to watch like a hawk. It's going to be very, very important. If you want to put on some positive lenses in your glasses, then the one thing that you could see is that the RSI has not yet dropped below the previous lows here. It's kind of a positive thing if you want to take it from the positive side. If this goes, then the orange area, the orange square, is potential target based on this head and shoulders pattern. So that's around the 405 mark. We go to the weekly chart and you see this in a bigger picture, and it looks as if we're now getting out of this starting channel here. This was a 1, 2, 3 point trend line, so it was reliable. We're breaking it, and you can see that 420 level coming back again. So this is 418 something, 417.45. We're shrugging off this negative divergence that you saw in the RSI, and the MACD is at a negative signal for a couple of weeks already. So here also, that 420 area, pretty important for SPY to hold up. If it doesn't hold up, then the area around 405 is the next target area. And the structure of the chart has been damaged, I think is the word. That will be structural damage to the chart, and we will need more time to get back into an uptrend, because right now, and especially when this level breaks, every move higher will run into resistance areas of the previous low, the previous support line, the old neckline. All of that will act as support on the way up. So the way up will get more and more difficult the more damage is done here. And here is the chart that I was talking about. SPY versus IEF, stocks versus bonds. We see this rally here. This was all very good, and now since this was July, you see that it's moving in a sideways trend, and we try to move higher, but we rapidly reversed back into that trading range. And I'm watching the lower boundary here. That's around 460. If that gives way, then based on this chart, we could go back down to 4.4 is the first one, and then 4.3. That's a pretty big move in terms of this ratio, and it would signal a preference for bonds over stocks. Right now, we're still in that range, but please take a look. Please be careful when it breaks below 4.6, and that will very likely coincide with a break below 420 in the SPY chart. Now for more positive things. So here's DJP. That's commodities, the commodity index, the Bloomberg commodity index, and you can see how it came out of this falling channel. Still in a little bit more of a sideways move. There is a little bit overhead resistance here, but look at the relative strength. This is what we're looking at. This relative strength is gradually improving, and there is a lot of upside potential. So with all the difficulties, the lack of momentum, the lack of upside movement in the stock market, I think that commodity markets will be a very good alternative. There is plenty of ETFs to play the commodity market. If I stay with DJP and GSG, they're the total commodity market indexes, so there's no split. They encompass all commodities. I think they certainly deserve a place somewhere in your asset allocation framework because of this improvement in relative strength as you see it right here. GSG is the same story. You see the strength of the improvement of relative strength over the last couple of weeks, and here it's a little bit more pronounced than in DJP. 23 is the area. You see how a new series of higher highs and higher lows is emerging. The last low came in higher, just above 21, and we're now working our way towards that. It's just below 23 US dollars. So when GSG breaks that level, the next stop will be 26, and you know that that is inside the monthly chart, which goes way back. There is a lot of upside potential in all commodity markets. And then finally, a quick look at Bitcoin. You saw the weekly chart turning up right here. This is the weekly chart of Bitcoin, and this is why you see Bitcoin turning up. Both RRG lines are still below 100. That's why it's in the lagging quadrant, but they both started to move up. That's why it's at a strong RRG heading. And look at this here. We're now, we tried the bottom area. There's the lower boundary of that trading range. Talked about it a couple of times. We're now definitely on the way to break that upper boundary. The last couple of days have been very, very strong for Bitcoin, and we're now at 31,600, challenging that broad resistance area. Don't forget, it's a broad resistance area, but things are looking better for Bitcoin by the day, and it's looking better than it has been for the last couple of months. And especially when you look at the daily chart here, you can see it's quite wild usually for Bitcoin, and you see some very nice upside shoots that then get corrected. But this is today, this is Monday, one big move higher, 31,626. We're definitely challenging that area. It's early, but my bias is to the upside for Bitcoin. I think that this time we will see a break above that 32 area, and then, you know, where can we go? I would say my first price target would be this previous high here, which is around $47,500. So that is a pretty decent upside potential for a risk asset, as Bitcoin is, compared to what's happening in the stock market right now. So there you have it. Stocks in trouble, fixed income picking up, stock-bond ratio probably under pressure. Good news for commodities, good news for Bitcoin. And then on to sector rotation. Lots going on over the last couple of weeks. Nervous market, I think that's the best way to qualify it. If we look at the weekly RRG, then we still have technology inside weakening and basically at a very strong rotation back towards the leading quadrant. We've got communication services already inside the leading quadrant at a good heading. And we've got energy deep inside the leading quadrant but losing relative momentum. So these are the sectors that are currently kind of driving the market, I would say. If we look at the other side, and that's by default, because these are very discretionary is inside weakening and moving to the left. So there's a lot of market cap weight here on the right hand side and close to 100 level on the momentum scale. And because of the mathematics, there has to be a lot of market cap to offset what's on the right hand side. I did a talk about that during the CMT symposium in April. So if you have a chance to look at that, please do, because that explains, there is an explanation on why that has to happen, why there has to be an offset of market capitalization on the left and the right hand side in a so-called closed universe as we have here for the 11 sectors in the S&P 500. If we look at the tails of those sectors, we can see that financials has rolled over and is now moving down. We see materials rolling over and moving down. We see industrials moving over and rolling down. We see real estate pushing into the lagging quadrant. Utilities is kind of in limbo. It's the lowest reading on the RS ratio scale, still very weak. We've got staples still inside the lagging quadrant at a very short tail, indicating that it is a stable relative downtrend. But if you look closely, then you will see that the last notch is kind of up for both of them. And then we've got healthcare that is starting to roll over. So all in all, this is a very nervous sector rotational pattern, I would say. Now look at the right-hand side where that daily rotations are, and you can see that over the last 5 trading days, energy has rapidly picked up, shooting off it back into the leading quadrant, supporting the longer-term strength of the XLE tail on the weekly RRG. But we see technology and communication services rolling over. They're moving lower on the RS momentum scale and marginally lower on the RS ratio scale. So they're not confirming the strength that we see on the weekly. So again, it's a big question now whether these tails will make a very rapid rotation and start to align with the weekly again, or will these move back here and eventually, but that's going to take a little while, make these tails here on the weekly turn around and start moving towards the lagging quadrant. No way to say that at the time being. We'll have a quick look at the charts for the sector, for the individual sectors in a minute. But from a sector rotational perspective, I think that we still have to conclude that especially technology and communication services are the strongest sectors in the market, especially because on the daily there's still the highest reading despite the slightly negative rotation. Now, if we look at the so-called defensive sectors, then we've got utilities here, we've got staples here, and we've got healthcare inside weakening and starting to move up. So this is definitely an improvement for these defensive sectors, although that is not yet visible on these weekly tails, but keep an eye on it. So with the nervousness and the pressure on the general market, it's the strength of the defensive sectors is not sending very strong positive signs for the market as a whole. Especially also when you look at the more industrial sectors, so that's consumer discretionary, it's industrials here, it's materials here. They're rolling over and they're pushing into the lagging quadrant, and they are confirming the rotations that you're seeing on that weekly chart. So all in all, under the hood, it looks as if the defensive sectors are slightly picking up, especially on the shorter term time frame. Not yet super visible on the weekly. And we've got economically sensitive, and communication services and technology are part of that economically sensitive group. Energy as well, are still on the leading side of the RRGs. If we look at a few of these individual charts, then here is materials, and you can immediately see the weakness here. We're moving towards the lower area, but look at the break in relative strength. So that is not a very good sign, and it looks as if materials will push into that lagging quadrant very, very soon. Here's communication services, still holding up very well. The price chart, not so much. There's still a ton of resistance around 69.5. But look at that relative strength line. That relative strength line is telling the story of communication services. It's pushing higher, and there is still quite some time, quite a little bit of upside potential left for XLC to go. So especially XLC, still one of the leading sectors here. If you look at energy, pushing against this all-time high, definitely living up to the expectations of strong relative strength. A little bit of trouble here. You see that momentum is leveling off, going down slightly, but you can see that here it's the highest reading on the RS ratio scale. So there is all possibilities for XLE to go through that corrective move, relative corrective move. So it means that this could move a little bit sideways and not go up as fast. Rotate through weakening and then rotate back up and still be one of the strongest sectors. The move out of that falling channel and the higher highs, higher lows on the relative strength chart for XLE are definitely underscoring such a scenario. Financials getting weaker and weaker. You can see how a series of lower highs and lower lows is now being in place. We just broke below the previous low, and that's being confirmed by weak relative strength, and that's the tail moving. It didn't even make it to the leading quadrant. It's just rolled over and is now heading lower towards the lagging quadrant. We look at industrials here. It was one of the better sectors, I have to admit. When it broke to new all-time highs here, that was a good sign. But it broke back below that breakout level, started a series of lower highs and lower lows, and now is back to the lower boundary of that relative trading range. And it looks as if we're going to break below it. The RRG lines are already taking a little bit of a leading role here, starting to roll over, and you can see the tail pushing into the lagging quadrant. So not a lot of good expectations for the industrial sector. Typical offensive growth sector. Technology, obviously, probably the most important sector in the universe here for the S&P 500. If we look at the chart, we see lows coming in around 161. So this is a strong support level. 161, strong support for XLK. What is not good is, first of all, the fact that we broke out of this rising channel. As long as we stay above 161, then you know, you could come up with the argumentation that it's a pause, it's a break of trend, it's not a turnaround, it's a break of trend. We hold 161, and after a little while, when supply has been digested by the market, we will see a new move up. But what worries me here is that we now have 1, 2 lower highs. So that means that sellers are coming back at lower levels, and buyers are not kicking in. So the lows are coming in lower, the highs are coming in lower, sorry. So supply is coming in faster and faster. That is putting pressure on the price. If that pressure continues and we break 161, that would be a really bad sign for XLK, for the technology sector. If that happens, the next level is 150. There is no support in between. Looking at relative strength, it's the other way around. We see that the highs are coming in and the lows are getting higher. So that's the reverse. So from a relative point of view, it's actually looking pretty strong. So I'm a little bit torn here between the price chart and the relative chart. They're conflicting. They're not supporting each other. I'm pretty sure that when 61 or 160 gives way, that relative strength will start to decline as well. But for the time being, I'm going to stay, because I have to, because that's what the chart is telling me, that technology is holding up the market. We're holding up above 161. We actually had we ended the day, it's a weekly chart, but we ended the day at a pretty good area, at least above where we opened, and we're pushing relative strength a little higher. So the relative strength for the technology sector, for the time being, is still holding up. I don't know how long that will work, but for now it is, and it's probably also keeping the S&P at current levels. Here is consumer staples. That's a typical defensive sector, but that's not looking very strong. So here is that my trouble with those defensive sectors. They're looking good on the daily, but they're not looking good on the weekly. So here is staples. You can see very short tail, a little pickup. That's the little pickup that you see here, but this trend is definitely lower, and there is not a real signal for a quick turnaround. So staples probably remaining here on the lower end of the RS ratio scale. We go to real estate. That is confirming its weakness. Again, this week we continued lower. We seem to be breaking below the previous low. Relative strength is moving lower and is pushing that tail down into the lagging quadrant. There's no doubt about it. This is a strongly underperforming sector. Here is utilities, same story. Like here it is on the lower end of the RS ratio scale, and look at that trend. That's a weak relative trend. We had a little bit of an uptick in momentum because it slowed down, but it's still down, and that's indicated by the stable low level of the RS ratio scale, and that's what's putting that XLU tail right here where it is at the lower end of the spectrum on the RS ratio scale. And then here we've got consumer discretionary. That is now definitely weakening. You can see that last week we broke below the previous low. We're confirming lower highs, lower lows. We've executed that double top pattern. And for now, I think the next target area for XLY is probably around 135. And look at how that RS line has now put in a new high. We took out the previous low. It's pushing the RRG lines lower. So if you ask me, it's only a matter of time before XLY will hit that lagging quadrant. And then finally, we have healthcare still holding up here, albeit marginally above this slightly rising support line. And the same goes for relative strength, although the bigger trend here is lower. And that's what you see in the RRG lines, and that's why XLV is positioned here inside the improving quadrant, but slowly rolling over as well. So we've got those defensive sectors not very strong, and that's the kind of the confusion and the puzzle, that the markets are under pressure, but the defensive sectors are not outperforming. And if the market is really under pressure and we really are in for a very strong and vicious market decline, I would expect those defensive sectors to be way, way stronger than they are right now. So I got to keep an eye on the rotation for these defensives and what's happening in SPY and whether it can hold that 420 level. And very likely the situation in technology sector, XLK, will be one of the key factors to ultimately decide what's going on with the rotation and the level of SPY. Okay, so last week I did a video on how the sensitive sectors continue to prop up the S&P 500. And unless people, maybe some people think I don't, but I do read the comments and I try to reply to all or most of them. And one of the comments actually triggered my attention, and that was on this one here. Somebody said, interested in the opinion of small caps. And I actually did an article. I wrote an article in the RRG blog on that subject, which is RRG is sending a clear message and finds 2 stocks with upside potential. The 2 stocks are a bonus for the blog article. But my point is that if you look at the rotation of large cap versus small and mid caps, the message is actually very, very clear. So large caps are rotating back up. They're pushing into the leading quadrant, and mid and small caps are in the doghouse. They are very, very weak compared to these. So this rotational image is a very clear picture in favor of large caps. And when you do that also for, or you take the RRG that breaks down growth and value into mid, small and large cap, then the message becomes even clearer. You can see that growth is right here, inside weakening and moving higher. This is growth large cap, and this is large cap, just large cap. So the growth large cap segment is sending a very strong message. It's the strongest segment of the market compared to all the others. There is a slight improvement for growth mid cap, but as you can see, it's far to the left and just inside the improving quadrant. Now that's an interesting picture, because we're talking about growth stocks and we're talking about large cap stocks. So what I did is I actually looked for the members of IVW. And IVW is the iShares S&P 500 Growth ETF. And it has 241 names in it. So these stocks, these 241 names are the stocks according to S&P are considered to be growth stocks. They got a ton of metrics that they run that entire universe through. So these are growth stocks. Now you would think that this list would be dominated by technology, industrials, materials, consumer discretionary, like the traditional offensive cyclical growth stuff. But when you look at the list, and the good news is you can sort them here on the sector, you can see that there's actually a representation across a lot of sectors. So here's communication services, obviously a ton of discretionary, but there are also a ton of energy stocks, and there are financial stocks. Healthcare, which is traditionally a very defensive sector, there's healthcare growth stocks, so there's growth stocks in a defensive sector. Industrials, not surprisingly. Here's real estate, here's staples. So again, a very traditionally defensive sector, ton of growth stocks in there. Technology, obviously, and then there's utilities. So even in utilities, there's a ton of growth stocks in utilities. Now, when you run an RRG, so I had to trim down that list a little bit, but you can read it in the blog article. But when you look at a trimmed down list, this list actually requires that the stocks are above their 5-day moving average, above their 20-day moving average, and the 5-day needs to be above the 20-day. So it's a very simple, moving average based filter, so to say. But the interesting thing that you can see is that in this curated list of growth stocks, staples, healthcare are dominating. So there's 2 industrials, 3, and there is an energy stock, there's material stock, 2 material stocks. But the defensive stocks, so these are defensive growth stocks. Now that is interesting because we just saw how confused the market is and how these defensive sectors are not really outperforming, which is something that you would expect when the market is under pressure. But here, when we look at the universe through this lens, through this growth value size lens, you can see that the stocks that start surfacing are the growth stocks inside the defensive sectors. So maybe there is something cooking underneath. I found that a very interesting. I wasn't really aware of the fact that these growth stocks were so widespread across multiple universes. I had actually expected way more concentration in the typical cyclical and growth sectors, but that is not the case. So I thought that was an interesting observation, and I shared it with you in the blog article. And you can look at that. You can look at that article and find that list yourself. There's no problem in finding it. And by the way, if you want to look at that RRG, it's a predefined RRG. If you go to groups and you scroll a little bit down, you can find growth value right here. That gives you the growth value rotation. And we also have the size rotation. That's the first one in that article, which is small and mid caps, and here is large caps. So you can see how that rotation is still working out. And then there is the combination of those two, which is, where is it? Here, growth, value, and size. And I always take this one off because that's also my benchmark. So you lose that dot in the middle, and you can see how growth, large cap growth, and large cap are on a roll. And here's growth mid cap starting to improve a little bit, and how all these others, and that's large cap value, value, mid cap value, small cap value, they're all moving towards that lagging quadrant. So in the market right now, the segment that is really holding everything up and outperforming is growth large cap. And then finally, as promised in the intro, a quick look at the differences, if there are any, between cap-weighted and equal-weighted sectors in the S&P 500. So I've loaded up the RRG with the cap-weighted sectors on the left and the equal-weighted sectors on the right. And if we do a very quick comparison, then I've sorted them on name so I can easily find the same sectors. Then you've got communication services on the same trail. And by the way, I am way more interested in the direction of the move, in the format of the rotation rather than the position on the RRG. Because if you look at the differences between equal weight and cap weighted, remember when I spoke about the fact that it needed to be balanced because there was a lot of market cap on the right, so you need a lot of smaller cap sectors on the left to balance out that universe. Here you can see the effect of an equal weight equal weight sectors in the universe. This is much more balanced because there is no effect, no impact of the market cap. So we had communication service. So look at consumer discretionary. You see the same type of rotation, bottom left towards lagging, inside lagging. Here you see staples. Slightly better on the equal weight, but the lowest reading, so still a very weak sector. Just like it is on the market cap, on the cap weighted end. But it looks as if equal weight is picking up a little better, but it's not much. It's still very, very weak. Here is energy. Look at energy, same type of rotation, same type of picture. Financials, same type of picture, same type of rotation. The format is the same. Position is slightly different, but as I explained it, that has to do with the cap weighted versus equal weight. Here is healthcare. That's quite different. Here you see healthcare inside lagging but picking up. So this is starting to be more positive. Money moving into healthcare when you look at an equal weight basis while it's rotating out of there on a cap weighted basis. So it looks as if there is money moving out of these out of the larger cap names inside XLV, because the equal weight is moving up. So there is a little bit more money flowing out of XLV when you look at large cap or cap weighted. So here is industrials, same format, same type of rotation. Here is materials, same sort of rotation. Here is real estate, definitely the same sort of rotation. Here is technology, definitely the same sort of rotation. And here is utilities. And here also you see quite a distinct difference where cap weighted is kind of struggling at the lowest level. There is a clear improvement visible for equal weight utilities. So the only two real differences between cap weighted and equal weighted are for healthcare and for utilities. Interesting to see that those are both defensive sectors. So the not mega cap, not large cap names inside utilities and healthcare are actually starting to improve. That's I think we can translate that as a move to more defensive positions. Anyway, as you've heard throughout the show, there's quite a bit of contradiction in the various, when you look at the universe through the various lenses. As long as the S&P is holding up above 420, we're still okay. XLK, large cap technology, probably very crucial. And don't forget to take a look at commodities in your asset allocation framework. And this wraps up Sector Spotlight for this week. Thank you for watching. I hope you enjoyed the show. Please remember, Sector Spotlight is available on demand on the StockCharts YouTube channel, usually recorded and uploaded on Mondays, uploading probably tomorrow morning on Tuesday this week. As usual, feel free to share your thoughts and ideas in the comments below the video. You've seen that I read and respond to them. I'm looking forward to seeing you again at a new episode of Sector Spotlight next week, same time, same place.